Today is Monday, March 8th, and this is a post-market review for the stock market activities today. A new fresh week with the same old story. We are seeing a tectonic shift from the technology slash growth slash momentum side of the market into inflationary and value names. And of course, this shift is happening rapidly and it is catching a lot of new amateur investors by surprise. They've been fed and told all along that you put your blindfold on and you buy your favorite technology stocks, your favorite growth stocks. You get a bunch of tickers from TikTok, YouTube, and the likes. You put your blindfold on and you buy. Ask questions later. Matter of fact, don't ask questions at all. And we've been saying all along that the fundamentals always matter. The stock market frenzy and the mania we saw last year of chasing names with no profits, sometimes without even revenue, and pushing those valuations higher and higher and higher, because you have a new generation of investor that pays no attention whatsoever to the valuations. They look at the price of the stock and they make decisions. Oh, stock can move from $100 to $300 to $500, and that is just normal behavior. They've been introduced to the market and spoiled by the very unique environment that was dictating the market last year. They've been thrown in the ring with no opponent. They had the whole ring for themselves. And now all of a sudden, the announcer announces that you got a new opponent that is about to storm the ring and have a fight with you. And this fighter happens to be a 21-year-old Mike Tyson. And all of a sudden, these investors who had the whole rank for themselves are now running for cover. As the rise in yields continues to go on due to the rise of inflationary expectations, you are seeing these multiples, the very overvalued names, being crushed very harshly. Meanwhile, there is a whole other market of value names, inflationary names, names that are not sexy and don't regularly attract retail investors' attention. And these names are actually trading higher. Amidst all the quote-unquote rout in the stock market, specifically in the technology names, these stocks, the value stocks, the inflationary stocks, are actually rising. And you saw the contrast happening clearly today, where the Nasdaq was trading in the red and certain names, the Teslas and the likes, trading down significantly. Meanwhile, the Dow Industrial Average managed to mark an all-time high reading in today's session. So you're seeing the contrast between two markets, one that used to work magically for over 10 years now. You pick a technology stock out of a hat and there is a 9 out of 10 chance you will make money. Easy markets, followed by harder ones. And now you have another market that was hated, ignored, thought of as too old, boring, now making a comeback and becoming the new hot trend. That is the inflationary and value stocks. A massive shift. Some will see it right away and adapt. Others will stay in denial. It will take them time and perhaps losing some money before they recognize the shift that is taking place in the market's topography. Now, the longer we continue to see the sell-off in the Nasdaq and the growth names, the more problems we're going to have in the broader market, because you cannot have this isolation going on forever. At some point, if the sell-off continues to go on, it will become contagious, and you will see the S&P 500, the Dow Jones, the Russell 2000 also declining along with the Nasdaq. Furthermore, let's not brush off the risk of margin calls. All of this sell-off, you have a lot of traders and investors who took a lot of risk. All of a sudden, they're exposed naked and there will be margin call. And you will see a lot of their stocks having to be sold off. And we know what the retail favorite stocks are. And they'll continue to get hammered, and they will continue to get hammered more and more if we reach the scenario of a tsunami for margin calls. Now, how did the day started today? We were down big in the futures market in the overnight session. And in the morning, and of course this is done by design, it wasn't a coincidence, David Tepper, a very big hedge fund investor, he could have showed up on CNBC during the halftime show or after the market closes, but he decided to go before the market opens for the purpose of attempting to prop up the markets. Whatever interest Mr. Tepper had in propping up the market, it might have worked in the morning and he achieved his purpose, but at the end of the day, we saw the dot pop got sold off right away in the Nasdaq. And all in all, the indices altogether managed to close at the lows of the day. And we continue to see certain names becoming the poster boys for this massive sell-off, including Tesla, aka the souffle. And the souffle has been hammered severely the last few days, down over 30% from the top as of today's session. We will talk about all of these subjects and a lot more during the Headlines of the Day segment. We will take a look at the charts and see where we go from here. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the green by 306.14 points, or a gain of 0.97%. And here is the contrast. The Nasdaq closing in the red, down by 311 points, or a decline of 2.41%. The S&P 500 also in the red, down by 20.59 points, or a decline of 0.54%. The Dow Industrial Average has less exposure to technology than both the Nasdaq and the S&P 500, and therefore it manages to outperform because the Dow Industrial Average has a lot of the inflationary stocks in it, whether we're talking about financials, energy, consumer defensives, and therefore you're seeing the contrast between the Dow and the Nasdaq. And what about the sector's performance? For the day, leading the pack and capturing the gold medal at number 1, financials, and number 2 for the silver, utilities, and the number 3 for the bronze, industrials. What about the laggards of the day? Led by technology, communication services, and consumer cyclicals. What do we make of the sector's performance today? Here is the take. While yields traded higher, specifically for the 10-year Treasury yield, reaching almost 1.6%, but not going significantly higher, as we saw during last week's activities. Now, higher yields are beneficial to financials, and therefore it is not a surprise that financials are outperforming today and finishing up at number 1. Yet the mystery is, why did utilities close at number 2 and manage to outperform, even though the rise in Treasury yields hurts utilities? So that is the mystery right here that has to be uncoded. Other than that, the inflationary trade is outperforming, but utilities is the outlier here. Could the rise in utilities today tell us something important, such as perhaps the market is not worried anymore about higher yields? The market is not selling off due to higher yields. And when we talk about the market, we're talking about the Nasdaq and technology names. Because if the sell-off today was due to higher yields, well, the 10-year Treasury yield was just a tiny bit higher, and we saw utilities outperforming. So why is the sell-off in technology and growth names continues to go on? Perhaps the sell-off has now evolved from just a fear about the rise in Treasury yields into an actual reassessment of positioning and valuations, at least from the institutional side of market participants, meaning that the last couple of weeks were just a wake-up call for them to review their positions. And now they're seeing all of these overvalued names, and they are starting to trim these positions and rotate toward valued names. Just something to think about to uncode the mystery of the outperformance from utilities today. Moving on to the futures market, and let's see what's going on here. Overnight, we saw crude oil surging higher due to specific news from Saudi Arabia, and we saw the Brent reaching all the way to over $70 a barrel before being sold off. And here is how we finished the session today. The WTI and the Brent down a little over 2% apiece. So have we reached a short-term top here for oil prices? Perhaps once we saw the number 70, traders started to question the move, saying, oh, wait a minute here, pushing oil prices all the way to 70. We haven't even opened yet. Perhaps we're going a little ahead of ourselves here. What about softs? We saw declines here, led by sugar and cocoa futures. Meanwhile, cotton, lumber futures closing flat, while we saw modest gains for both OJ and coffee futures. And what about metals? The dollar index surging higher once again, and that should add some pressure specifically on metals futures. And we saw declines here yet again for gold and palladium. Meanwhile, copper futures closing flat, silver with modest declines, while the only winner here in metals futures is platinum, closing a little over 1% today. What about meats? Modest gains across the board. Live cattle, feeder cattle, lean hogs. When we take a look at grains, flat across the board, modest gains here and there, but the largest decliner is canola futures. Canola futures have been on a tear, and they're now taking a break and perhaps will resume the trajectory higher very soon. Moving on to the big casino, the options market. Let's see what's going on here. Fear has invaded the market. Check out the volume. We're completely dried out, and traders are so scared to place any bets in the market because they got burned. They're programmed on autopilot to buy call options, and they got burned at least 2 weeks in a row now. Massive losses, and either they're too scared to roll the dice once again, or that the damage was so severe that we are starting to see a lot of traders are now underwater and they don't have any more money to gamble with. They're all tied in other investments, and they don't have any more cash for options gambling. And they are waiting for what? They're waiting for the new stimmy checks. $1,400 a piece. You can buy a lot of options with those, so perhaps we are getting closer for at least a short-term bottom. As soon as these checks hit the market and we see call options buying resuming, you bet that would create at least a short-term floor in the growth and momentum names. But here is the rankings for today's activities in the options market. Number 1, Apple, with a little over 1 million contracts. About 73.5% of those were calls. At number 2, AMC, with a little over 300,000 contracts. About 73% of those were calls. Coming up, number 3, Tesla, with a little over 230,000 contracts. About 52.5% of those were calls. And what about the unusual trades that took place in the options market today? What about the trade for the ticker SPY for the S&P 500? You know, the bulk of the pain has been on the NASDAQ, but looking at the charts and reading the psychology, I do believe that the S&P 500 will join the NASDAQ in the declines very, very soon. And I actually did follow this particular trade because traders are making a bearish bet here by buying the 352 puts for the SPY expiring March 26 with expectations that the S&P 500 will decline over 8% by then, and they paid about $1.75 a piece to enter this trade, bringing the total all the way to about $2.5 million. And what about the trade for the ticker JEF? This is for Jefferies Financials. They're making a bullish bet here by buying the 35 calls expiration date April 16th with expectations that the name will gain over 10.5% by then. They paid about 65 cents a piece to enter this trade, bringing the total to about $900,000. What about this trade for the ticker IWN? This is the Russell Value ETF. Value has been outperforming, and somebody's betting on this theme to go on because they bought the 170 calls expiration date March 19th with expectations that the IWN will gain over 6% by then, and they paid about $3 a piece to enter this trade, bringing the total to about $4 million. Now, what about this trade for the ticker DASH, DoorDash? I am short the name, and somebody agrees with me because they're making a bearish bet, a big one, by buying the 125 puts expiration date March 12th, meaning this upcoming Friday, with expectations that DoorDash will decline over 6.5% by then, and they paid about $8 a piece to enter this trade, bringing the total to about $8 million. $8 million. The DoorDash will decline over 6% by the end of the week. And what about this trade for the ticker KWEB? This is for the China Internet ETF. And somebody's making a bearish bet here. The name was down big today, over 7%. And somebody's betting on more pain to come by buying the 74 puts expiration date March 19th with expectations that the name will decline over 5.5% by then. They paid about $1.50 a piece to enter this trade, bringing the total to about $1.5 million. And what about this trade for the ticker TAL? This is for TAL Education. The name has been hammered severely the last few days, and today was down about 9.5%. But somebody's betting on more pain here by buying the 65 puts expiration date March 19th with expectations that the name will decline over 5.5% by then. They paid about $1.10 a piece to enter this trade, bringing the total close to $1 million. And what about this trade for the ticker DIS? This is for Disney. Disney has been trading in Mickey Mouse land, way overextended, but somebody's betting that the Mania is about to hit the brakes because they're making a bearish bet here, buying the 190 puts expiration date this upcoming Friday, March 12th, with expectations that the name will decline over 6% by then. They paid about 69 cents a piece to enter this trade, bringing the total to about $500,000. Moving on to the headlines that shaped the day, starting with macro news. And right away in the overnight session, we saw oil prices surging higher. And here's the reason why. Saudi Arabia said one of the most protected crude facilities in the world came under missile attack on Sunday, sending oil prices surging to above $70 a barrel. And of course, we are facing this inflationary environment, and inflation fears invaded the market, that this will only add to more inflation expectations, specifically related to gasoline prices. And here it is. Americans' inflation expectations hit a 7-year high as the economic recovery picked up, Fed survey finds. More details. New York Fed survey of consumer expectations forecasts sharp increases in gas and rent prices. Consumers expect gas prices to rise by a median 9.6% over the next year, up from 6.2% in January. Rent is expected to increase by a median of 9% over the next year, up from 6.4% in January. Inflation expectations also rose. Year ahead, median inflation expectations rose to 3.1% in February versus 3% in January, the highest reading since July 2014. So the inflation storm is now at full force. Even the American consumer and households are now expecting more inflation to the highest levels since 2014. And how are our leaders handling all of this surge in inflation expectations, the fear of higher inflation? Well, they're responding by propaganda and more BS. Here is Treasury Secretary Janet Yellen on the prospects of too much inflation, quote unquote. I really don't think that is going to happen. Inflation before the pandemic was too low rather than too high. Yes, Madam Secretary, and the key word is before the pandemic. We are now after the pandemic. Perhaps a thing or two changed since the pandemic, Madam Secretary. I'll leave you to figure that out for yourself. Here is more from the godmother. Yellen says if package turns out to be inflationary, there are tools to deal with that. We'll monitor closely. Again with the tools. They get the tools for everything. Don't worry about it.
Do you feel the charge?
Moving on to sentiment news. And here it is. What about the options gambling mania? And this is from last week, by the way. Almost 32 million call options traded yesterday, the fifth most in record. The other four all occurred within the last 4 months, meaning that we have a lot of bag holders this week. And how did the recent market sell-off impact retail investors? Are they a little phased by what took place in the market the last 2 weeks? Are they revising their strategies, reassessing the risks, or are they doing what they've been doing before? Here it is. Over the last 3 weeks, retail investors snapped up on average $6.6 billion in U.S. equities each week, according to data from VanderTrack. That is up from an average of $4.7 billion in net weekly purchases in 2020. So once again, nothing will faze them. Put your blindfold on and go Naruto style, heads first, buy now, ask questions later. Matter of fact, don't ask questions at all. But perhaps questions are being asked when it comes to Tesla witch Cathie Wood. ARK Mania not doing so hot, so ARK funds fall into a bear market. Investment firms, ETFs, are down more than 20% from their peaks amid tech share decline. And here is the summary from last week's outflow for ARK Invest. The ARKQ down $96.5 million. The ARKW down $197.1 million. The ARKF down $94.6 million. The ARKG down $183 million. Meanwhile, the big one, ARKK, was actually up $46.8 million due to donkeys thinking that they're smart and they bought a bunch of call options attempting to buy the dip in the RKKKKKK. And the total outflows were $524.4 million. And of course, Tesla witch Cathie Wood, she knows she's in trouble. The Holy Spirit-based investing. But now that we're seeing yields rising higher and markets are getting harder, all of a sudden Holy Spirit-based investing and let God feed me some tickers is not working anymore. And perhaps ARK Invest will end up being just like all of those technology internet funds we saw back in the 1999-2000 dot-com bust. They were the hottest funds in town, outperforming everybody on the street. It was a fad, and once the crash happened, investors lost 60, 70, 80% of their investments. Meanwhile, those fund managers managed to walk away very, very rich. And of course, Tesla witch Cathie Wood was asked about the insane valuations she's investing in and the impact that the current sell-off would have on her funds. She continued to deny, and tell everybody that this is actually good for her Mania names because the rally is quote-unquote broadening. Well, Cathie, if it is broadening without you. And then when asked about the souffle's insane valuations and why she's buying the dip in these very elevated levels, why sell your liquid holdings to fund your illiquid holdings? And Tesla witch Cathie Wood went on to ramble for 2 minutes straight, nothing but gibberish, using the same lame excuses that, oh, Tesla deserves to be overvalued more than the entire auto industry combined due to its, wait for it, upcoming robo-taxis. Where are the robo-taxis, bro? I remember that Reverend Elon Musk said that robo-taxis will be out by 2019. Well, we are now at 2021. Where are the damn robo-taxis? And then she goes on, oh, Tesla's developing this chip and it's going to be way better than NVIDIA. She's been saying this for about 7 years now. And how the hell does a new chip from Tesla justifies a company trading at over $800 billion when they only generate about $30 billion in revenue every year? The competition is rising and commodity prices, input prices are surging higher. The bubble busts. Traders plowed billions into electric car stocks before the slump. Here comes the slaughter. A plunge in the stocks of electric vehicle makers is lashing investors who plowed billions into the sector this year in a bid to surf one of Wall Street's hottest trends. Tesla led the week's drop in the auto sector that has battered the holdings of fund focused on this part of the market. That is painful for traders who poured almost $2 billion into electric car and battery-focused exchange funds in 2021, according to Bloomberg Intelligence. ETF assets in the segment had swelled to a record $4.6 billion before the sell-off. This is from the Financial Times, calling the pop of the bubble, the EV mania, comes to a crashing end. This is the electric vehicle bubble, and this is the crash. Don't say we did not warn you. At Pixel, the entire EV space is collapsing. Tesla's down 11%, Chinese competitor NIO down 13%, and so on and so on. Just click on the sheet, it's a vast wash of red. Total market cap loss since the top stands at an astonishing $730 billion. Make that over $800 billion, including today's session. Gone in little over a month, just like that. The only question left is, when is the bottom? Well, given the old school automakers trade at 0.6 times revenues versus 14.4 for the cool electric vehicle kids, we might only be getting started. Broken clock chimes welcome below as always. Of course, this is due to the very, very rude and emotional Tesla culties who attack everybody and anyone who disagrees with them. They have to defend their cult leader, Reverend Elon Musk. But here it is. Tesla breaks a record, the biggest 6-week drop in value ever. And what about the SPAC mania? What's going on with the SPAC maniacs? Well, one of their cult leaders stabbed them in the back. Shamath Spacaria sells the remaining personal stake in Virgin Galactic worth about $213 million, taking a massive dump on the little heads of his cult followers, and then making lame excuses on Twitter saying that he had to sell to fund his climate change ambitions, while he laughs all the way to the bank watching his cult followers burn. And of course, with all of the warning signals that we have presented for you over and over in this channel, the EV mania, the ARC mania, the call options mania, the SPAC mania, the Davy Barstool mania, and after massive losses during the last 2 weeks, there are still donkeys out there from the quote-unquote experts. Equity strategists are as bullish as ever despite all the nervousness among investors about sky-high valuations and rising rates. And what about Tom Lee from Neptune? Tom Lee says the market sell-off is a buying opportunity, and he said that last week, and the week before, and the week before, and the week before, and the week before that. To infinity and beyond, Tom Lee from Neptune will say that the market sell-off and the market rally and the market consolidation and the market existence and non-existence is a buying opportunity. But not everybody out there is a donkey. Here is a contrarian view. Tech stocks are selling off. Don't buy the dip. Sell the bounces, strategist says. In our call of the day, Miller, Tabak and Company Chief Market Strategist Matt Maley said investors need to be careful, very careful, about buying the dip when it comes to the technology-laden index and should instead be selling the bounces. Maley said that despite a nice bounce, quote-unquote, on Friday, the index still closed the week below 13,000 and said any more downside in the near term would be quote-unquote very negative on a technical basis. Miller Tabak stressed it wasn't calling for a repeat of the Nasdaq slump in 2000, but said it was clear the trend had changed following last week's losses. Therefore, Maley recommended investors sell on any bounces for now and look for quote-unquote some capitulation before they get more aggressive on the buy side of things. And I do concur. For now, the Federal Reserve did not address anything at all. Matter of fact, they're allowing rates to rise higher. And I told you a few days ago that the Federal Reserve Chairman Jerome Powell gave us the green light to short the hell out of this market because he's not going to do anything to stop the rise in yields. And therefore, stocks, specifically the technology and growth stocks, will continue to decline and decline and decline until the market finds a footing. And that footing will happen after massive declines. So until the Federal Reserve addresses the issue, the rips are too short. Moving on to corporate-specific news, starting with the souffle. Tesla. The souffle has been on the ride of pain for about a few weeks. Massive declines, popping of the bubble. And here is Reverend Elon Musk. Elon Musk set records last year for one of the fastest streaks of wealth accumulation in history. Now it is going the other way, almost as quickly. And of course the Rev doesn't care because he is already rich, but his cult followers are feeling the pain. Tesla's new social network spurs owners to take political action on its behalf. Of course, the culties need their safe place to chat, conspire, and support themselves. But we have more bad news for the souffle because the competition is heating up rapidly. VW's new electric car is the most credible challenger yet to Tesla. New UBS report says VW might not be the Apple, but the Samsung of the EV world, with profitable, high-volume EV brands. And it's not just coming from VW. Tesla is slowly losing its electric car crown as Ford Mustang Mach-E cuts into sales. But once again, the ARC maniacs and the cult followers of Tesla witch Cathie Wood continue to believe that buying the dip in Tesla makes sense even though all of the signs point to more competition, higher input prices, and a loss in market cap. But the robo taxis, bro. And here's the last bit of corporate news I got for you. For Disney, just in, California officials say theme parks and stadiums can reopen as soon as April 1st. Of course, the entire economy of California got decimated, specifically in the small business side, due to the corruption, stupidity, and misguided decisions by our beloved governor Kim Jong-un Newsom. But lucky for him, the federal government just passed a stimulus, bailing out the state of California. And no, I'm not a MAGA guy, I'm a California hippie. But even I say that King Dracula has to go. Moving on to the heat map analysis. Let's see what happened today. As expected, weakness specifically from the technology momentum side of the heat map. We're talking about software names, semiconductor names, the big technology stocks. And the mystery is now solved, by the way. We witnessed Facebook and Google outperforming last week, but this week they're joining the declines from Apple, Amazon, Microsoft, and Netflix. Anything that has been momentum, whether we're talking about Tesla, Carvana, NIO, all the EV vehicle makers, Peloton was down big today, Zillow, DoorDash, even within the healthcare sector. Whether we're talking about biotech, Moderna, or diagnostics such as Illumina, even financials, PayPal, all being punished here. Meanwhile, what's being rewarded is a combination between the inflationary trade, financials, industrials, energy, materials, defensives, plus some of the reopening plays such as airlines, cruises, hotels, apparel retail, casinos, etc. And the big question is, as the hot technology names continue to decline and reach oversold conditions, and as of these reopening/inflationary plays go higher and start to read overbought conditions, will we see a rotation, or will we just see the inflationary trade also joining the journey to the southern destination that is going on right now with the Nasdaq? And if that is the case, it will be due to a panic event. Moving on to the themes analysis, starting with the nostalgia stocks. These are the reopening names, and as you can see, all in all, significant gains across the board. Whether we're talking about Southwest over 6%, Disney over 6%, AMC over 15% gains, Six Flags, American Express, the Cheesecake Factory, all with massive gains for the day. Money is still chasing these reopening names. But we also have another theme going on in the market, the inflationary trade. Gains across the board, whether we're talking about financials such as JP Morgan, US Bank, or credit services, MasterCard, American Express, industrial names such as Boeing, Waste Management up 7% last week, up another more than 2.5% today alone. What about Westrock? Up over 18% last week and already up another 5%. So the theme is very clear. These inflationary names are benefiting tremendously. They are the new tech, so to speak. And what about the deflationary trade? Pain across the board, very few exceptions here. We saw massive declines from Snapchat, Zoom, the likes of Peloton, Square, DoorDash, down almost 12% today alone. And it was down double digits last week as well. Massive exodus here from these high valuation stocks. Moving on to the charts analysis, starting with the SPY 15 minutes chart. We opened trading higher, recaptured the level of 386, but failed to keep it as support, and finally getting rejected and trading lower all the way toward the end of the day, forming a double top formation that is supposed to lead us lower in tomorrow's activities. The SPY is starting to look a little weaker here, as if it is saying, if the Nasdaq goes down, I can't hold for any longer. I have to go down too because of the weighting of the technology sector. And we are looking for the level of 374 for support. Moving on to the daily chart of the SPY. Once again, bad closing. Matter of fact, very bad closing, reaching all the way, recapturing the level of 386, and then nose diving, closing at the lows of the day, getting rejected from recapturing 386, meaning that the SPY will go down at least to 374 before establishing any support. Now let's take a look at the SPX, a weekly picture. We are applying the Fibonacci retracement levels to illustrate for you that the correction hasn't even started in the SPY. The MACD is curling downward, creating red impressions in the histogram. We are facing a very strong and steep resistance line that goes all the way back to 2019. Furthermore, we haven't even closed down in the first Fibonacci retracement channel. We have room to go down all the way to the end, the lower end that is, for the level shaded in red, meaning that this is the next shoe to drop. We will see declines here for the S&P 500 going all the way down at least to retrace the first Fibonacci level of about 3,500. Now, will that be outflow from the SPY into the Qs? That is the $1,000,000 question. Or will it be an all-in-all decline for every index in the market? Speaking of, let's talk about the Qs. 15 minutes chart. Once again, not even trying to go to the important level we talked about yesterday of 313, briefly capturing 308.5, but then getting rejected harshly. I'm breaking two support levels today, 308.5 and 303.35, closing just a hair above the next support level of 299. Very bad closing here, the Nasdaq. Significant weakness. We were expecting the Nasdaq to build on Friday's rebound at least to the level of 313. Failing before doing that is a very, very ominous signal. What about the daily chart? Once again, remember when I told you that someday we will go through all of these support lines like running your fingers on guitar strings, and that would be music to the ears of bears. And here it is. This is bear music. But let's establish some support lines here by visiting the continuous contract of the Nasdaq. Right away, you see what happened here. We rebounded all the way to the resistance level of 12,766. Rejected right away, and the rejection was so harsh that we breached the next support level of 12,408. Now, we have few support lines here, but it looks like the Nasdaq will nosedive aggressively because it is failing over and over again here to hold support and to hold a bounce for more than a day. It is failing right away. Once again, it is a tectonic shift that is going on in the market, and perhaps it will be violent. How violent, you may ask? Here is the answer. How about 17.5% declines from the top, going all the way down to visit the major trend line in yellow? This is assuming that the sell-off will accelerate once again in tomorrow's session. What about the IWM 15 minutes chart? Doing a little better here than the other indices, climbing and claiming the resistance now support level of 218. But is anything changed here for the IWM regardless of the outperformance today? Not at all. Here is a weekly chart for the IWM. The MACD is starting to cross to the negative territory, creating red impressions in the histogram, indicating a loss of momentum for the IWM. Furthermore, we haven't had any meaningful correction in the IWM throughout the rally. Perhaps we're seeing the first one. We will trace back all the way to the first Fibonacci level of about 199, which comes close to my level of 196.5. But rest assured, the IWM will break very, very soon. Moving on to the dollar index. Another massive day of gains for the dollar index, and the destination is 93. Remember, the rise of the US dollar is not that good for the stock market. It is not doing anything to curb copper, lumber, crude oil prices. All of what will be achieved from pushing the US dollar higher is that some of the inflationary trade, such as energy and materials, will join the declines with the Nasdaq. What about gold? Gold in a make or break moment here. Either you will catch support and bounce from the very important level of 1675, or the floodgates will open once again. Moving on to the 10-year Treasury yield, TNX. What's going on here? Another day to the upside, and the trajectory is higher and higher and higher. The momentum is very strong here from an RSI, MACD perspective, and the tailwinds from the macro environment support higher prices in the TNX. Even though we have a massive short position against bonds, specifically the TLT, but that is not an indicator right away that we will see a short squeeze in the TLT and bond prices, because the sell-off in bonds could get even more aggressive and extreme. Moving on to the VIX. What's going on here? Went up, it went down, but all in all managed to close above the very important support level of 25. The VIX remains stable, but perhaps if I am right and the S&P 500 will join the declines in the Nasdaq, we will see the VIX exploding higher. So SPY going lower, the VIX going higher. And what about Apple? 15 minutes chart. Apple was supposed to hold 120. That was the channel. Hold 120 and march all the way to 125. Right away in the morning, struggling to hold 120, breaking it very violently and consolidating in a bear flag formation throughout the day and then flushing slowly but surely all the way till the end of the day, breaking the next support level of 117. And by the way, Apple was down early in the morning while the Nasdaq actually was trading in the green. And I issued this tweet saying, as Apple goes, so will the Nasdaq. The Nasdaq could not just rally without the participation of Apple. And Apple was down big and it pulled the Nasdaq down with it. So what do we see here from a daily perspective for Apple? The next support line of 113, and 113 must hold. It is a very strong support and it is a very critical support that must be defended. So Apple has to hold 113, or if it breaks 113, then we are dealing with something more ominous here than just a mere correction. And what's going on with the souffle? Tesla, massive declines, down over 35% from the top. And of course, this is a very difficult chart to navigate. And a lot of technical analysts try to avoid analyzing Tesla's chart. Not in this channel. We've been covering Tesla's chart every single day, and we nailed it every step along the way. And I told you that 599 in Tesla was supposed to hold support. But once the Federal Reserve chairman came out and gave us the green light to short, I told you I'm not going to switch from puts to calls. I'm actually going to double down on my puts. And you saw Tesla breaching 599. But once again, the top in Tesla also was called in this channel when I told you I'm not going to short Tesla until and unless we reach the level of 84 in the RSI. And that was exactly the top in Tesla. So what do I see now? How about we go and visit the weekly chart of Tesla? It is the most significant chart to look at here because regardless of any bounces that we might see in the daily chart, the weekly chart is indicating that the pain has just started. Take a look at the MACD, the first significant crossing in Tesla's chart history in the MACD, creating red impressions in the histogram, meaning and indicating significant loss of momentum. Now, let's use the Fibonacci retracement levels from the start of this rally, this incredible, massive rally for Tesla. As you can see, we've breached at least 2 Fibonacci retracement levels, and now the next destination is around 485. Who knows at which level the market will decide that this is a dip worthy of buying in Tesla. But you have some levels here to look forward to. 485, and then we're looking at 387.5. And that should hold. The level between 387.5 and 485 should hold for support because it is a very strong support level. But we are trading right now at 563. If we go down to 400, we will lose over $160 from the current stock price, meaning massive declines about to come. So once again, the souffle not looking so hot so. And now, let's move on to conclude this video. Here is a tweet I issued today. It is tough for Powell and company to implement any yield curve control measures when the Dow is making all-time highs. The market's changing its landscape and investors will just have to adapt to it. About time for value stocks to outperform. Meaning that how do you expect the Federal Reserve to take any action to curb the rise in Treasury yields when the Dow Industrial Average is making all-time highs? Why is this fixation to save technology stocks? Jerome Powell will not take a radical measure regarding yields just to save the technology sector. If we see an overall market sell-off, then we have a different conversation. But so long as the Dow is marking all-time highs, then where is the problem? So I expect more pain here for technology stocks if yields continue to rise higher, because the Federal Reserve will not do anything at all until this correction in the Nasdaq morphs into an overall market crash. Here's another thing. I tweeted this February 25th. The sentiment today was, I'm writing a shopping list to buy from the sell-off in this market. And I said until we change this sentiment, the market hasn't found a bottom yet. And indeed, we continue to decline since I wrote this tweet. So let's check back on the sentiment. Are people still thinking that all the sell-off is an opportunity to write a shopping list to buy from this correction, I see that this sentiment got shot a little bit more this week. They're a little more scared than last week, but not enough. There are still people writing a list to shop from, assuming that this is just another dip to buy. And lastly, I presented you with this diagram a few weeks ago, and we identified the market at the level of delusion. And I used the corrupt face of Josh Brown from CNBC when he said the valuations and fundamentals are junk science, and I called it delusion. And then the same Josh Brown of CNBC said that Warren Buffett, Berkshire Hathaway style of investing is irrelevant anymore. And I told you that we are now in the new paradigm. They believe that this time is different and there is a change that nobody else has seen. But after 2 weeks of pain, we have now shifted to a new stage of denial.
Holy shit! I had no idea, did you?
Of course I did. You were so high on skeg, you wouldn't know if you had your mother's muff on his head.